Is an inherited IRA considered taxable income? Have you ever wondered what happens to an individual retirement account when someone passes it on to you? The tax implications can be a bit tricky, so let's break it down. When you inherit an individual retirement account, whether it counts as taxable income really depends on the type of account and your relationship to the original owner. First, let's talk about traditional individual retirement accounts. These accounts are funded with money that has not yet been taxed. So, when you inherit a traditional individual retirement account, any money you take out is usually taxed as ordinary income. This means you will pay taxes based on your current tax rate when you withdraw funds. The good news is that if you are under age 59 and a half, you will not face the 10% early withdrawal penalty that typically applies to retirement accounts. Now, what about Roth individual retirement accounts? These accounts are different because they are funded with after-tax dollars. If you inherit a Roth individual retirement account and it meets the 5-year holding requirement, you can take distributions without paying any taxes. However, if the 5-year rule is not met, any earnings you withdraw may be subject to income tax. It's also important to know that inherited Roth individual retirement accounts must follow required minimum distribution rules, which usually requiring the account to be emptied within 10 years for beneficiaries who are not spouses. Speaking of beneficiaries, the relationship to the original account owner plays a big role in how you can manage the inherited account. If you are the spouse of the original owner, you have more options. You can treat the inherited account as your own, rolling it into your own individual retirement account. This allows you to delay required minimum distributions until you reach age 73. Alternatively, you can keep it as an inherited account and follow the distribution rules for beneficiaries. If the original owner passed away before taking required minimum distributions, you can delay your distributions as well. For non-spouse beneficiaries, the rules are a bit stricter. You generally must withdraw the entire balance of the inherited individual retirement account within 10 years of the original owner's death. If you take distributions from a traditional individual retirement account during this period, those amounts will be taxed as ordinary income. For Roth individual retirement accounts, qualified distributions are tax-free, but remember, you still need to empty the account within that 10-year timeframe. When planning for retirement, it is essential to consider the tax implications of inherited accounts. Distributions from inherited traditional individual retirement accounts can increase your tax liability in the year you take them out, which might push you into a higher tax bracket. On the other hand, inheriting a Roth individual retirement account can provide tax-free income, which can be beneficial for your retirement planning if the 5-year rule is satisfied. It is always a good idea to consult with a tax professional to navigate these rules and make the most of your inherited individual retirement account. Understanding how these accounts are taxed is key to effective retirement risk management and planning for your financial future.